Well, good afternoon or good morning, depending on where you are today. Welcome to our investor call briefing covering the first quarter of the 2017 financial year. I'm Chris Andrews, Chief Investment Officer here at Latrobe Financial, and it's terrific to see a large number of people from across Australia and internationally as well joining us again today. A few points of housekeeping before we begin, as always. Now, these sessions are designed to encourage questions. You should be able to see on screen where you can type yours, and I can see some people have already submitted those. So as the presentation proceeds, please enter your questions. I'll answer as many as I can at the end of the presentation on a first-come, first-served basis. Now, with the numbers attending, I might not be able to get to all of them today, so I apologise for that. I will finish this session promptly at 12:30 Australian Eastern Summer Standard Time, but I'll follow up individually with anyone that I've missed after the teleconference. I should also point out that I won't be commenting on individual portfolios or assets today. As always, our investor sales team is ready to assist you on any of these matters at our free call national number, 1-800-818-818. And as a final point, I note that this presentation is accredited for CPD points with the MFAA and the FBAA, so please email us at marketing@latrobefinancial.com.au and we'll send the details of this through to you. So, on that note, let's begin. Today's investor call will provide you with our current view, our thinking, about the key issues driving investment opportunities for you generally in the world today. Now, first we're going to look at the macroeconomic landscape, both domestic and global. We'll then update you on the Australian property market. Third, we'll give you an update on Latrobe Financial. And finally, we'll review the quarterly performance of our $1.2 billion Latrobe Australian Credit Fund investment accounts. So let's start with our headwinds and tailwinds report, our macro view of the domestic and global economies. And the first headwind that the Australian economy, that the world economy, and that investors face is, of course, political turmoil. When we look internationally, we've got the polarised and frequently astonishing US presidential campaign that's set to draw to a conclusion on the customary, if I could say, somewhat idiosyncratic date, which is the Tuesday after the first Monday in November. This year, that's 8 November. There's a fair streak of populist protectionism at play in the US and elsewhere that, if unleashed, could have significant negative repercussions for the market and for investors. Then you add the Brexit issue. We've got Article 50 of the Lisbon Treaty to be triggered by March 2017, so markets will be very carefully watching the outcome of exit negotiations. We've of course got an EU leadership who will be very keen to discourage other departures from other countries by ensuring that the UK's exit is not easy. Then we've got the constant international flashpoints. We've got the South China Seas, we've got Vladimir Putin's Russian regime, either or both of which could be the catalyst for serious international conflicts, including military conflicts. And then domestically, we've got the Turnbull government's woes. They've been ceding a two-party preferred lead to the opposition now, and with a primary vote lower than when Turnbull took power a year ago, we're creating a very challenging environment for markets and investors. We continue to rate the China debt story as a significant risk and as a headwind for the global and Australian economies. Now, the Bank for International Settlements has, since the global financial crisis, been tracking international money flows, including household and business credit as a percentage of GDP. As you can see on screen, China has far and away the highest credit to GDP gap of any G20 nation, currently sitting at more than 30 percentage points. As we've said so often before, China has some unique characteristics which could allow it to work through this issue, but if you learn anything from economic history, the longer the medicine is delayed, the more painful the cure. Then there's the Australian share market. The graph on screen is extraordinary, really. It shows that over a period of precisely 10 years, the ASX 200 has been entirely flat. That is a whole decade lost for share market investors. It also shows that whilst time in the market might be a popular strategy, timing the market is also critical if you want to succeed at share investing, and that's the insight actually that's driven the focus on from investment theoreticians over recent years on sequencing risk. In any case, flat equities markets are a significant headwind for investors, and with domestic growth and inflation figures pointing to an extended period of low growth, it's hard to see a catalyst for substantial upward movement into the medium term. So those are the headwinds. Let's turn to the tailwinds, and as always, there are plenty. There's no doubt that the Australian economy as a whole is benefiting from record low interest rates. This is not an unmixed blessing over the long term. Now, many economists and commentators are concerned that current rate settings are distorting asset prices. They're actually punishing savers, driving up global systemic leverage. That's a real issue for pension funds, insurance companies, other key players in the world's economic infrastructure. They're all facing significant unfunded liability issues arising from these low rates. You've even got sort of industry luminaries like Bill Gross now beginning to openly muse on the inflection point. That's when investors will lose confidence in the current system and desert what Bill Gross describes as the standard financial crisis. But for us, and for now, especially here in Australia, where we've at least kept rates in positive territory, low interest rates are a distinct tailwind, and they are supporting the rebalancing of our economy. Similarly, low inflation is, on the face of it, a great thing for an economy. And from that point of view, the current print shows that the proverbial inflation genie is well and truly in its bottle. But imagine a scenario when it becomes incrementally harder year on year to repay your home loan as your pay packet gradually shrinks. That's deflation. And on a household level and a macro level, that's why central banks have lowered rates so dramatically around the world. They are desperate to ensure that some level of inflation remains in the system and protects the world from entering a debt spiral that could quickly get out of hand. So take a look at the euro area, or even Japan, where Abenomics has given a sugar hit to the economy that is fast diminishing. The second tailwind is our rebalancing economy, and the data on this point is well and truly in. As has been reported as ad nauseum, there has been a substantial decline in mining investment, and we can see that on screen. However, that has been offset by growth in other areas, including residential construction, export volumes, household consumption, which is growing at a reasonable rate, although there are some signs it's come off a little lately. All in all, a really good smooth landing at a national level from an unprecedented boom, which is, of course, not the story you'll hear the papers run with. Bad news sells. Finally, there's unemployment, which has fallen and is also a tailwind for the economy. It should be noted, however, that there are significant differences in the unemployment rate across regions. In addition, there has been a significant reduction in average hours worked. And that suggests, of course, that we might be looking at heightened levels of unemployment. So you'll see the issue of underemployment becoming a significant talking point over the next 3 to 6 months. So if we keep our eyes on the really big picture, the Australian economy has and continues to deliver beyond all expectations, especially given the very soggy global economic conditions in which we're living. There are parts of Australia that are really battling, but on average, outcomes are far better than one would have expected. At the same time, the world is operating in an unprecedented environment as far as policy settings are concerned, and investors have to be aware of the risks of significant asset revaluations across all markets when these settings unwind. Okay, so on that note, we turn to the Australian property market, which has been again a significant topic of interest in the media. Residential real estate is by far Australia's largest asset class. It has a whopping $6.6 trillion market value, which is roughly 4 times the market capitalisation of the ASX. When you add commercial real estate at $0.88 trillion, the combined value of the Australian property market is an extraordinary $7.5 trillion. You mightn't guess that from the rather bland graph on screen, but the measurement of Australian house prices has become the scene of one of the most heated debates in economics and statistics in recent years. Now, the Reserve Bank's recent expressed views on house prices has been quite benign. In other words, they're saying house prices are growing solidly, but not excessively. In its October interest rate statement, the RBA reported slowing house price growth when compared to a year ago, but acknowledged recent strengthening in some local markets. It signalled out issues like higher lending standards, more cautious lenders, and lower turnover as slowing the increase in price growth. It also pointed to the slowest growth in rentals in decades, an increased supply of apartments coming on stream over the next couple of years, all as being very relevant facts. Now, normally this sort of commentary is uncontroversial, Australia is very well served in our view by a number of house price index providers, and they use a variety of methods to measure changes in housing values. There's the Australian Bureau of Statistics, which publishes the least timely, perhaps the most comprehensive index, and 3 private indices, CoreLogic, APM and Residex. As you can see from the graph above, graph on screen, they generally track very closely together. While there are month-to-month variations between the indices, they generally present a very consistent picture of market trends. Recently, however, a gap has opened up between the indices. You've got to remember, this is not unprecedented. In fact, history tells us that the indices tend to diverge from time to time. Interestingly, often at market inflection points. And these divergences reflect the different index methodologies. The current divergence is so significant because it comes at a time when the RBA is using house prices as a key data point in making its decisions on official cash rates. The orthodox view is that the RBA does not want to see house price growth accelerate to the levels seen in 2013 and 15. So if the RBA takes the view that house price growth is still very strong, as CoreLogic's index, for example, suggests, perhaps the Reserve Bank would not have made the August official cash rate reduction to 1.5%. We've added the latest available numbers from each of the providers on screen. Now, the ABS and APM use a stratified approach. So they group houses into price levels and take the median result. So this adjusts for so-called compositional effect. If, for example, at a given point in time, lower value houses tend to be dominating sales, they could otherwise drag the median house price down. CoreLogic uses what is known as a hedonic methodology, where sales are adjusted for the specific characteristics of the property being sold. So it'll take into account factors like number of bedrooms, block size, location, etc. Most statisticians will agree that, at least in theory, a hedonic index is the gold standard. Now, in practice, there will always be arguments about the precise mechanics of the hedonic mechanisms and the assumptions that lie behind it. Finally, we've got Residex, which uses a repeat sales methodology. So that examines purchases and sales of the same properties over time. Now, in our view, all these methodologies have their place, all serve us well, but when they diverge at key policy inflection points, we have to look a little closer. And here are the 5 key indicators we at Latrobe Financial are watching very closely at the moment. First, as we've already said, interest rates. And as we said before, the RBA cut rates in August to 1.5%. Now that has kicked off the latest round of controversy. As we've discussed, some commentators, and we'd include ourselves in that number, are concerned that the worldwide low interest rate environment and so-called unconventional monetary policy risks sowing the seeds of the next economic crash. As we've previously pointed out, the orthodox view is that the RBA felt able to reduce rates in August and then earlier in May, largely because it was reading house price growth as cooling. Now, some prominent commentators, and we've got Goldman Sachs, Tim Toohey, AMP, Shane Oliver, the AFR, Australian Financial Review's Christopher Joy among them, they will believe the RBA was too relaxed on the house price front and argue that the market is reacting quite strongly to the rate cuts. And is driving quite a strong resurgence, particularly in Sydney, to house price growth rates. Another indicator that we're watching is auction clearance rates. Now, you could say that this measure sometimes receives too much attention. Only a small proportion of housing sales are executed by auction. Even in Melbourne, which is the undisputed capital of auctioneering in Australia, auctions typically only make up around 1/3 of sales. In Perth, for example, it's less than 5%. What's more, auctions tend to take place for higher value properties, which arguably creates a compositional bias in the figures that they're reporting. Nevertheless, they are a real-time indicator, and in the current situation, very interesting. As you can see from the graph on screen, auction clearance rates are at very high levels and have been for a number of years, but are certainly at very, very strong levels. However, as you can also see, it's on a very low number of sales when compared to the same time in the previous 3 years, and we've circled those statistical artifacts to bring it to your attention. That's an important point, and we'll return to that in a moment. High clearance rates do tend to suggest higher prices, although lower volumes, if seen across the market, suggests that any price pressure is actually coming from reduced supply rather than increased demand for dwellings. The third indicator we're looking at is asking prices. Now, asking prices are again a really good real-time indicator, and they reflect really well on current house seller sentiment. So we're picking up the sentiment of the selling market. Our good friend Louis Christopher and his team at SQM Research do an excellent job tracking asking prices on a city-by-city and national basis, and you can see that on that national basis, asking prices are up nationally 4.6% for houses and 2.8% for units. As usual though, the city-by-city analysis is much more interesting, remembering there is not one property market in Australia, but a whole series, a patchwork of markets. Canberra, Sydney, Brisbane and Adelaide are relatively stable and positive. Perth and Darwin are still experiencing a lot of pain, but the surprise is perhaps the strength in Melbourne and Hobart, where houses and units respectively are showing very strong growth indeed. Now, for Hobart, there's a suspicion that there may be some higher end units skewing the figures or some statistical artefacts there, but it is notable. Certainly a 25% year-on-year increase is significant. So, taking a step back, these three indicators that we've looked at the moment, lower interest rates, auction clearance rates and asking prices, all support the thesis, the idea that house prices are perhaps rebounding off lows earlier this year, and that we should be thinking about whether the market is getting overheated on the back of recent interest rate reductions. But there are also some very significant indicators mitigating that story. Now, the CoreLogic combined capitals turnover rate shows a really dramatic decline in transactions in recent months. This confirms our earlier insight from auction clearance rates, of course. So the price pressure seems to be coming from reduced supply rather than overheated demand. We appear to have the same or perhaps even lower numbers of prospective purchasers chasing a lower volume of product on market. Now, note that these figures have been revised before, so we'll wait on that. But taking them on face value, they are a really important indicator. Total listings are down in the key states of New South Wales and Victoria, as well as the ACT and Tasmania. In fact, the only significant increase in listings comes from Western Australia, where, as we know, we still see distressed purchasers forced to put stock on market, given the economic softness that they're experiencing in the wake of the mining boom. The other indicator mitigating the housing boom narrative, of course, and this is a really important one, is credit formation rates. As the graph on screen shows, housing credit growth is around multi-decadal lows. Now, this is consistent with lower home loan approval data, as well as the general tightening of credit standards that's been going on throughout the industry over the last couple of years. The bottom line, house price increases need watching most carefully when they are driven by a boom in credit. That is what we saw in the United States in the lead up to the financial crisis. Rapid credit growth fueled by poor lending standards and in many cases outright fraud led to unsustainable leverage. By contrast, going back to Australia, we've seen subdued credit growth and strong, even tightening credit standards industry-wide. So the evidence at the moment suggests that while recent interest rate decreases may have poured some fuel on the fire and you know, frankly, we'd prefer no further reductions in official cash rates, we are not seeing an unsustainable credit-fueled boom. We're seeing solid price increases for the Sydney and Melbourne markets on the back of reduced supply and healthy borrower balance sheets. On one view, in fact, the stock of homeowners ready to capitalise on increasing markets by selling properties may have been exhausted. For the rest of the country, however, conditions are subdued, and Perth and Darwin are still retracing boom time gains. Meanwhile, you'll continue to see commentary on the massive increase in building approval, multi-level construction in specific locations, as highlighted from the graphs on screen, which we've sourced from UBS. I'll do some quick comments on that. Happy to follow it up in questions later. I see I've got a couple on this topic. First, approvals are not the same as completions. There are significant issues for developers obtaining finance. Many approved projects simply won't proceed for lack of funding. Second, notwithstanding this, construction levels are elevated and in specific geographic locations elevated quite dramatically. Some areas face potential oversupply issues in the next 18 to 24 months. Melbourne and Brisbane inner city locations face the greatest challenges here. Third, in our view, this will not have as significant impact on the broader market as many are predicting. Much of this stock has been built for a niche market, overseas purchases, and the supply of traditional Australian targeted stock remains stagnant. So that's the property outlook. Now let's turn to the Latrobe Financial Group update, and we'll return to some of those property issues in response to some of the questions I'm seeing on screen, so I look forward to that in a few moments. And it's been another terrific quarter for the Latrobe Financial Group. Funds under management has grown very strongly, both at a retail and group level. Group funds under management have exceeded the $3 billion mark in October, and retail funds under management have exceeded $1.2 billion. Group revenue continues to accelerate quarter on quarter as funds under management grows, so that's very pleasing. And group equity is a very strong $109.7 million, again reflecting the commitment of the shareholders to the long-term future of Latrobe Financial and our operations. So that takes us to the detail of our retail investment offerings, the Latrobe Australian Credit Fund. And remembering, as usual, as we always say, our fund is not a bank deposit and has very different risk-return characteristics, and also noting that past performance is not a guarantee of future performance, you can get a sense on screen of the fund's performance profile by looking at the key indicators. So if we focus first on the classic 48-hour account, formerly known as the cash and mortgages option, it's currently outperforming its benchmark, the official cash rate, by 1.7% per annum. It's got a weighted average LVR loan-to-value ratio across the portfolio of 66.7% and 90-day plus arrears of just 1.2%. So a very strong profile for investors and an offering that we're very proud of. Our 12-month term account, formerly known as the pooled mortgages option, also continues to provide a stellar performance profile. It has over $500 million in funds under management and is outperforming its benchmark by 2.02% per annum. With arrears of just 1.1% and 1,500 individual first mortgage loans, it is a powerful offering again for investors. It maintains its independent rating and is in fact the highest independently rated fund in the sector in Australia. The Select Investment Account, again formerly known as the Select Mortgages option, is Australia's largest and most robust portfolio of peer-to-peer investments. Now, we've been managing these peer-to-peer investments for over 20 years. We've got over 5,000 investors, 5,010 individual investors investing peer-to-peer through our platform, through their self-managed super fund or personal accounts, and achieving terrific results, as the portfolio summary on screen shows. The shopping list on our website offers outstanding peer-to-peer functionality, and we'll have more enhancements coming in the months ahead. It's also the only independently rated peer-to-peer offering in the market, so that's a really powerful plus. For the more experienced investor, our high-yield peer-to-peer option is also attracting a lot of attention. We've currently got $68.4 million under management in the high-yield investment account, predominantly in mezzanine loans and mezzanine RMBS notes. And these offer strong yields backed by highly diverse portfolios. So that's the nutshell summary of the fund. Should also announce we've been really pleased over the last quarter to make a full commercial launch of our Latrobe Direct online investment portal. Really encourage you to get online to have a look at that and see the outstanding technology and functionality that offers to our investors. We're seeing a really significant take-up on that, so that's been a really significant development for the group. So on that note, I'll turn to the Q&A. I've got time, about 5 minutes left, so time for a couple of these questions today. So let's turn to the first. And the first I'm looking at is from Anthony. Thank you, Anthony. And you're asking, given market speculation about overbuilding of apartments in some cities, what is your exposure? Thanks, Anthony. Well, yes, that is a really topical issue at the moment. To be very direct in my response to your question, our exposure, so if you look at the 12-month term account, our sort of flagship portfolio, that has just a 2.3% exposure to high-rise dwellings and a 3.5% exposure to inner city dwellings. So it's a very small part of our portfolios, not a significant part of our lending program. More broadly, I certainly agree that there is a risk of excess supply of apartments in specific geographical locations. if you look at the data on dwelling approvals and construction approvals going on at the moment, we will see Brisbane could have an uplift of up to 25.4% in unit stock over the next sort of 18 to 24 months. Melbourne, an increase of somewhere in the order of 16.1%, and Sydney about around 13.1%. Now, obviously, this is based on approval data. As I said before, not all these approvals will result in builds. There is some early evidence that the non-build rate might be slightly higher than normal for the reasons that we've discussed. But there is still a risk in inner city Brisbane, North Brisbane, inner city Melbourne, places like that. That could result in pressure on developers, could result in potential unit price declines. But the broader market, the broader dwelling market in Australia is still in long-term structural shortage. I'll post some graphs and material on this on Twitter. If you're on Twitter, by all means have a look at LFC Andrews is my Twitter handle, LFC Andrews. I'll post some graphs on that and to sort of illustrate that point better. But the basic proposition is that there is some risk over the next 18 to 24 months in particularly concentrated segments of the market, but the broader housing market is still facing a significant supply shortfall issue, and we believe that's going to continue to support, broadly speaking, the house price market in Australia. So thank you, Anthony. Turning to a question from Tina. Focusing on interest rates, and do we expect there to be more interest rates either next month or in the next few months? Okay, so yesterday's inflation print was watched very carefully by commentators, and it was mixed, to be honest. The CPI inflation was up 0.7% against a market expectation of 0.5%. But underlying inflation is still at 1.5%, which of course is below the mandated inflation target for the Reserve Bank of 2 to 3%. Now, economic theory would say that with inflation below target and fears around wages growth, things like that, conventional economic theory would say that the central bank should cut rates to stimulate the economy. However, in our view, there's a strong argument that conventional monetary policy has reached its limits. Interest rates cuts are not delivering investment anywhere other than, of course, arguably in the housing market. So the decision for the Reserve Bank becomes an interplay of other factors like exchange rates and the housing market, for one. You know, markets are currently pricing the prospect of a cut next month at 16%. In our view, you know, taking the longer term view and sort of moving away from, oh, will there be a 25 basis points adjustment down or up over the next couple of months, it's hard to see there being a significant structural change in interest rate settings still into the medium term. As you know, we came out sort of 3 years or so ago and said we thought rates would remain around these levels for the next decade. Well, here we are about three years in on that and see no real reason to change our views there. Next question is from Bruce, and Bruce is asking whether we have any thoughts on TD rates, term deposit rates. I'm assuming meaning there, Bruce. Yeah, well, if we look back to sort of June, July, May, June, July, perhaps this year, some were talking up the prospects of a banking term deposit war. That, of course, never happened. It was the proverbial damp squib. The best rates on the market at the moment are without checking, somewhere around mid-twos. The big four banks, I think you're seeing sort of low to mid-twos. That's really where our offerings have become so important for many investors, and that's what we hear from advisors again and again. Now, I stress, as I said before, our offerings are not term deposits. They're not government guaranteed. They're different risk-return proposition. But when we're looking at term deposit rates in the twos, and you compare that to our 12-month rate of 5.2% per annum, our 3-year rate of 7% per annum, it's a really useful alternative for investors, and certainly that's the feedback we get from a lot of our advisors. So on that note, we're out of time. I still do have a series of questions to follow up on. So Mark and AJ and David and Clifford, I'll be following up with you shortly. Apologies that I couldn't get to it in this session. Our team, as always, is standing by, ready to assist you with any questions you have in relation to your investments. We are very grateful and remain very grateful for your support and interest. Whatever market you're in, we hope it's profitable. Bye for now.